Hi everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. Hello, welcome back to SBR Technical Deep Dives. So I'm Rosie. I am a fellow of ACCA and head of technical accounting. And in today's podcast, we're going to be tackling the bit of IAS 19 that trips up even strong SBR students, unfortunately, and that is plan amendments, and specifically what happens to the accounting when a defined benefit pension scheme is changed during the year. Why does it split the year in two? What changes when it does, and why does it matter so much for the numbers? So that's what we're going to look at today. So let's get into it. I think first of all, what actually is a plan amendment? Key. So it's exactly what it sounds like. So the employer changes the terms of that defined benefit pension scheme during the year. It usually means that it's increasing the benefits the employees are going to receive. So the pension promise just got that little bit more generous. So maybe employees now retire earlier. Maybe the benefit formula is improved. Whatever that change, the scheme now promises more than it did before, and that has immediate financial consequences for our reporting. So think of it like this. Think you've promised a group of employees a certain retirement package, and then halfway through the year, you're going to upgrade that promise. And the moment that you do that, the cost of that upgrade lands immediately. Yeah, you can't spread it, you can't defer it, it's just done. And IAS 19 says that the cost hits that P&L right now, and that's the past service cost. But the past service cost is only the beginning of this, because the amendment also changes two other things. All right, and that is where quite a lot of SBR candidates do get a little bit stuck. So when that plan amendment happens, three things change simultaneously, and you need to account for all three. The first thing is that past service cost. That is the immediate cost of that benefit improvement. We recognise that in the P&L at the date of the amendment. There's no vesting conditions, no spreading. IAS actually was amended specifically to make that immediate in the past. It's gone from being a debate to actually a rule now. Okay, so it's immediately in the P&L, done. The second thing that changes is the net defined benefit liability. So that amendment makes the pension promise more generous, so that obligation for the company goes up. That net liability is remeasured on the amendment date to reflect that new promise. Now, this is your new starting point for everything that comes after. All right. And then the third thing that changes is the discount rate. And this is often one that many people forget. So the discount rate that's used to calculate the interest cost on that net liability is reassessed at that amendment date. Well, why? Well, because the discount rate under IAS 19 is based on high quality corporate bond yields. All right, and those yields change over time. So the rate at the start of the year might not be the same rate at the amendment date. So you're just going to reset it ultimately. And that's where the year sort of splits in two. Yeah. So this I like to use a bit of an analogy for, so hopefully it helps. Imagine you're driving from, say, London to Edinburgh. Halfway up the motorway, you get a call and you have to swap cars. Different car, different speed, different fuel consumption, everything different. You can't describe that whole journey using just the first car or just the second car. You've got to split it. First half in car one, second half in car two. And that's exactly what a plan amendment does in your IAS 19 calculation. So before the amendment, you use the opening net liability and the original discount rate to calculate the interest cost for that period. But then after the amendment, you use the revised net liability and the revised discount rate to calculate the interest cost for that remaining period. You can't apply one rate to that whole year. And that is the mistake that I see when I've marked this, and the students that I've mentored, is that they take that opening liability and apply one discount rate and calculate that interest across the 12 months. And that is the wrong movement because of that amendment. All right, that rate did change, the liability changed, and the year is in 2 halves. So let me just walk you through how the interest actually works with that split in the year. So let's say the amendment happened on the 1st of July, so halfway through the year, just for ease. So for that first 6 months, you take that opening net defined benefit liability and you apply that original discount rate. Yeah, and we time apportion it for the 6 months. That gives you the net interest cost for the pre-amended period. And then we make that amendment on the 1st of July, and 2 things are happening at once. The past service cost is recognised immediately in the P&L, and then the net liability is remeasured upwards to reflect those improved benefits. That new higher figure then becomes your starting point for the next half of the year. And then for the second 6 months, you take that revised net liability and you apply the revised discount rate. Again, we apportion that for the 6 months. And that gives you the net interest cost for that post-amendment period. Okay. So your total net interest cost for the year is the 2 halves just added together. And your total P&L charge is that current service cost plus the past service cost plus both halves of that net interest cost. Yeah, 4 components, each one is traceable and each one is earned separately. Now, a bit of the truth about why this topic really confuses a lot of candidates and where candidates tend to lose marks. It's not that the concept is really, really hard, a little bit confusing, but it's not impossible. But under exam pressure, your brain automatically defaults to a simpler version of whatever you're looking at, okay? Maybe one rate, one liability, just a 12-month period. And it feels right because it's much tidier, yeah? But it is wrong. And that lovely examiner knows this, okay? So that's why plan amendments appear with a rate change and a mid-year date every single time they're tested. Yeah, it doesn't come up in every exam, but when they have been tested, this is what it tends to test. They're specifically checking whether you know the year splits. And the signal in the question is always the same. Yeah, you'll be given the opening net liability, then a separate set of figures after the amendment, and a different discount rate. That's not extra information to confuse you. That's the examiner ultimately telling you, split the year here. Yeah. Use the first set of figures and the first rate for the period 1, and use a second set of figures and the second rate for period 2. So when you see those 2 sets of numbers, that's kind of your cue to think, this is what it's testing. So hopefully that's helpful. But one thing before we wrap up. So remeasurements, yeah, actuarial gains and losses, they are not affected by the plan amendment in terms of where they go. They go to other comprehensive income. We don't recycle to the P&L ever, just as we know. But the plan amendment does produce a past service cost, okay, which is the P&L. But any actuarial movements after the remeasurement of the liability, those are OCI. So keep them separate. All right, they're 2 different things, and the exam will test whether you know that that's different. Okay. So pulling it all together, plan amendment triggers 3 things simultaneously: past service cost recognised immediately in the P&L, remeasurement of the net defined benefit liability, and a remeasurement of the discount rate. Those last 2 split the year into 2 periods: pre-amendment, which is the old liability, old rate, and post-amendment, which is the new liability and new rate. And interest is calculated separately for each half and then added together. The car swap analogy is one of the ones I'd hold on to. I really like that analogy. So different car, different conditions, same journey. You have to account for both halves separately. And when you see 2 sets of figures and 2 discount rates in an IAS 19 question, the examiner is telling you to split the year. They're giving you a bit of a clue. Don't flatten it into one calculation. Make sure you split it. That is where the marks are. Okay. So I'll be back soon with another deep dive. I'll see you then.